TGIF. Which this week stands for thank God it's falling. At least for the bears. Oh no, that TG, yeah, thank God it's falling. And you know what I'm talking about. So last Saturday, I couldn't have dreamed we were going to do this. 3,100 seemed ambitious to me. Okay, thank you, Steve. Okay. I don't see it. Anyway. Okay, so you would have thought that maybe precious metals would have been a good place to hide. And a lot of people are saying it's, you know, margin selling, but, you know, all the way up. And early this week, I showed this 3 drive that we had in silver at the highs right here. So you really couldn't hide in silver, down $2 from high to low. Longer term look at this is you see this move here from 1950 to 1650. So what if we get 1.618 of this from here? And if we have equality, we're going to take out this low. So trying to hold the 200-day in silver, but you can't call this a good week, can you? Okay. Gold a little better, but after today, lower on the week. Gold silver ratio, I think, is about to make new highs, so maybe there's going to be something to do here. Yeah, I think we're at new highs on the gold silver ratio. There you go. Diverging. So perhaps there's something setting up here. You know, everyone thought this was the top, myself included. Few guys I interviewed didn't think so, thought gold would still lead the way. Makes me think of Dan Popescu. He said, you know, and other people said, you know, forget about silver, it's about gold. And this definitely does find them out. You know, you're going to pull back in the yuan here. I thought by now it's actually a negative week. So negative, negative, negative. The only place to hide was something else that I showed all the way back here was TLT. Breaking out of this symmetrical triangle, compressing, and was bullish this because of yields. And when I was talking about a 135 10-year, that seemed ambitious. We're trying to put in a floor. Maybe the market bottoms after we get to 110. Okay, and you know, when you think about it, if the metals couldn't perform, and they did perform, let's face it, gold was a monster move. But I do think that if we do get a turn in yields after, you know, some people talking 110 to complete it, and yields start heading up, then the gold bears will have an argument about opportunity costs, especially if we're on our way back up to here.
Gold, Dale, doesn't really care about nominal yields, as you know better than anybody. It cares about real yields.
Okay.
So I mean, it's not a factor of, you know, what's going to happen with nominal yields. It's at the same time what's going to be happening with inflation. So one of the reasons I believe we're seeing this pullback, other than the obvious, you know, gold especially was overdone. I mean, it had to correct lower. Is that perhaps people believe that what happened in 2008 and 8 is going to, you know, repeat today?
So you think it's just margin selling?
No, I believe that some people might have started worrying that what's happening now might lead to a recession because the economy was anyhow weakening, which might lead to deflation. I wouldn't be that sure in this case, as I've said some time ago. I wouldn't be sure that the next recession is going to be, deflationary.
Well, I'm really never sure about anything.
Yeah,
Are you?
no,
I
nobody
mean,
is,
so I mean,
100.
I don't know if it applies to trading. I think I could say I think there's a high probability, but that's as sure as I could ever get.
Yeah, I agree
So,
with you, obviously.
I do think though that even bigger bubble than stocks eventually is going to be in the debt markets. So,
100%.
here's your first.
Probably the biggest we've seen in the history of financial markets ever.
Yeah, so here you go, TLT on the weekly, first time, right? So this was one of the reasons I thought TLT would make a new high was this, right? And it doesn't always work, confirmed highs. It could have kept going down, but we're not confirming here. We're really not even confirming there. We're diverging on the 4-hour. So, around 110 in the 10-year yield plus, what's going on during this recent decline in yield is we're not inverting. Actually, the yield curve is steepening during this decline. Normally, it'll steepen when yields are going up, and it's actually steepening while yields are falling. I think that's a market message. So the long end of the curve, I think, is going to be one of the best shorts for 2020.
So far, we have followed the path that we've always seen ahead of a recession. The yield curve inverted, like, what was it, half a year ago?
Yeah.
And
almost again.
traditionally, what we've seen is that recessions don't come when the yield curve inverts. They actually come when the yield curve uninverts, and then we start getting steepening.
Yeah. Okay. And that, I think there's a top coming in bonds. Not yet. And also on the political side of things, it's very possible that Trump just lost the election for 2020 by not shutting the borders earlier. And that's why he looks pretty aggravated as the market falls. So I think a lot of people will blame him. Steepening means the long end yields are either not falling as fast or going up faster than the short end. Okay. So that's about all I have. It's a historic week. We're going to cap it off with David Brady. And David is one of the better minds in the industry, so it's going to be interesting to hear what he has to say. I kind of have a little bit of a hint that everything has become binary, which, is kind of what happened this week with, metals and the market. It's all about liquidity. And it seems like everything goes up together. And this week, almost everything fell together. So, that's, I think, one of the themes David Brady will be talking about later. So stick around for the top of the hour. And I'm going to turn it over to the guys here. Good morning, Blake. How are you? Thank God it's falling.
Oh my gosh.
TGIF,
Thank
huh?
God it's falling. That's funny. Thank God
If you're
it's falling.
short.
Holy
Yeah.
cow. So wow, what a week.
Yeah. History.
Last night, if you guys use ForexAnalytix, if you go over here to the S&P analysis, where is it? I have to find it. Okay. Basic technical analysis, end of day analysis. The S&P closed on the lows and below some key supports as we closed below 3,000. That was a big confluence in the long-term 38% retracement and 6-1. Whoops, that's supposed to say 618. I do analysis so quick, sometimes there are typos. Of the May 2009 lows to highs. The next support is the 2863 50% retracement, which is the 78% retracement, smaller time frame as RSI is deeply oversold. So we came pretty darn close, pretty close to those levels. Now the question is, are we going to get a bounce here? And my 2 cents is this: bounce, it's going to be fairly short-lived if we do. If we do, I would say a move back up to 3,000 is going to be somewhere in this neighborhood is where you're going to find sellers. Now, the question that you're going to have to ask yourself is, and it's probably going to be somewhere between 3,000 and maybe 3,600. Why are we bouncing? You know, if we're bouncing just because we're oversold and we bounce, the bounce is probably going to be fairly shallow. If we're bouncing because there's a lot of chatter about the Fed might, cut rates, do an emergency cut, which I doubt it, but I think it is a risk. Let's say they do, we will shoot up a lot faster and quicker, but the rally will fail or fade probably within a couple of days. There was a comment that Chi in our chat room he made, which is 100% true. Monetary policy, an adjustment in monetary policy cannot help a health condition, which is very true, but it can ease the pain a little bit, like aspirin if you've broken your arm. But the fact of the matter is that any type of bounce that we see from some sort of Fed induced reason would be fairly short-lived. I think probably a day or two versus a fade intraday or over one day, back up to above 3,000 would be faded pretty quickly. A little bit taller or bigger move higher, would be faded within a couple of days. So that's just something to think about as we make our way through and navigate through this end of month flows. Now, speaking of end of month flows, the dollar is expected to have strong end of month buying. It's flipped. It was end of month selling, but due to the move that we've seen in equities, we are expecting the opposite. Well, the banks are. I've seen end of month flows come in completely wrong, so it's really hard to gauge, and especially in this type of environment when you're seeing a massive amount of liquidations in the market, it's hard to gauge where the selling or buying is going to come from and how aggressive it's going to be. So don't get too caught up on what you're reading if you're reading any bank research on how strong buyers or sellers are going to be in the dollar. I think that the risk, like the risk was overnight with the euro dollar, that we were going to get a squeeze in the euro overnight due to liquidation issues. I thought that was an issue, and we spiked. Now the question is, will the euro be able to hang on? Because the euro is actually trading quite heavy right now. You look at the daily candle and you're like, wow, that's ugly. But before you get to pants in a wad here, understand that this is the very early in the day. By the end of the day, the euro could trade right back up to 110.30, and we're going to go, okay, well, it's still bullish. You know what I mean? So don't get too overly worked up about what you're seeing on these charts at this moment. Okay, the euro is trading pretty heavy though at the moment. I'll give it that. And one of the things that I'm playing into right now is I'm short a little bit of Euro Aussie and Euro New Zealand, and let me show you the reasons why. The Euro Aussie hit the channel resistance, 161% extension, very overbought here, so it looks like it's going to come off. And we're talking about what could happen here with the Euro Aussie. If there is a rally in equities, we would see the we would see the the euro's really coming off here. We would see these do really well. I mean, when I say do really well, they would reverse quite aggressively. Euro New Zealand also right up against big resistance here, And so you got to be aware and cognizant of that as we're heading into North American trade. All right. So you just got to be careful with some of these that have moved so far. I mean, you look at this rally, we've gone from 168 to 177. That's a 900 pip rally over the course of a week and a half. All right. Euro Canadian, same thing. You know, but wow, look at that. That's a big move lower already. So some really big moves in some of these crosses. And like I said, if equities continue to do well, you're going to see these really come off. All right, so that's something to think about. I want to point out the dollar really fast. This is an update that that's important. The dollar index came down, tested the 50% retracement, and is bouncing. So just keep that in mind as the dollar index looks fairly constructive. As long as we hold above here. Now, remember, it's end of month. This is all end of month moves. So, you know, be really careful getting too wrapped up in what you're seeing here, because we can whip around quite aggressively. And, you know, like, let's just say the Fed, let's say they, for some reason, weird reason, they did cut rates, the dollar would probably fall pretty aggressively. We would see the dollar index fall. So just note this is probably really important support for now. Okay, so just keep that in mind. Let's take a look at some. I know we looked at the S&P, so let's look at the S&P and let's look at the Nasdaq too. I haven't done a lot of work on these charts in a while, so I think it's probably a good time to see what we're dealing with. The Nasdaq tested the 200-day moving average. Some of our sharp traders in our chat room said, hey, before we bounce in equities, this is yesterday, the Nasdaq probably has to test the 200-day moving average. And they were exactly right. The Nasdaq did test the 200-day moving average, and we're bouncing from it. Here's the 38% retracement. Here's the Dow. The Dow obviously has gotten hit pretty hard. We are holding, which is actually fairly impressive for the Dow right now. We're holding some support. I know you're like, wow, that's impressive. What are you talking about? That's been a pretty big move. And like I said, I actually think based on what's happening with the coronavirus and everything else, I actually think that the market is probably going to be going lower longer term, but that doesn't mean that we can't bounce from these areas. So just because we are trading relatively weak at the moment doesn't mean that we can't. There's such big moves that if I had to imagine what's going to happen, and like, let's just say the Dow, probably something like this, and then an eventual break lower. You know what I mean? Because the markets don't move in one fell swoop, so we're gonna get some volatility, which is good. That's what we've been really waiting for all of us. We've been wanting some volatility. I think this is what we're going to be getting. We're going to be getting some volatility, which is going to allow you guys and myself to make some good trades. The key is being able to navigate through the volatility as it's coming. And that's one of the reasons why, in my opinion, ForexAnalytix is so powerful, not just because of the tool itself, but because and all the analysis that comes with it, but it's because you're in the chat room and you're talking with myself and the rest of the other traders throughout the course of the day. If you don't know what the chat room looks like, this is it. You can see there's Amanda, there's Dom, there's Chris, he's Travel Brit. We've been chatting all morning. Stelios is there, Amir, Benedict, Nitish, Takis, just DK, bunch of us, and you can just see that we've been chatting all morning long. This is me, and I've just been up for the last couple hours. I was just back here, So anyway, I'll take everybody off Jumbotron here. But oh, there you go. There's Jumbotron. Everybody that was listening in, they're all there's Gee, what is that? Martin. Okay. All right. So anyway, thanks guys. I think she just made boobs, if I'm not mistaken. I think he did. I think that's what that was. Anyway, all right. So a couple other things I want to point out. The US dollar Mexican peso, what a massive, massive squeeze. If I was trading a peso, this is one of those things that if I think really stocks are going to recover, a close below 1967 in the dollar Mexican peso, that's my that would be my trigger. That would be my okay. I'm gonna short the dollar Mex, and I think stocks are recovering. It's go time. That's what I would be doing. Is you know, right below there. That's where I would be, you know, thinking. All right. So just a little heads up on the dollar Mex. That's the those are the levels, right? We hit the 78% retracement, and matter of fact, if you look at yesterday's analysis for the dollar Mex, let me see if last night, break of the trend line puts a 618 retracement at 1961 in play. The long-term downtrend line at 1975 level dotted may soon come into view as long as stocks are being sold. And we went right into it, and now we're at the 78% retracement. And you got to also think with this dollar Mexican peso, I'm not trading it at the moment. You know, if we do close lower or, you know, towards the lower end of this level of the day, then you're going to get some like false breakouts too. So that's something else to think about. Like I said, I do not have any exposure to the dollar Mexican peso at this point, but it is something that I'm keeping an eye on. All right. Okay. So Steve, Stelios, Coach.
Hey, Blake.
How do you guys feel about the sell-off that we've got going on right now?
Hello. Well,
Quite interesting, huh?
My personal opinion, I've said this in the chat room this morning, I think this is far from over. And we've been saying this for a while. It's I think the whole situation has changed. The buy the dip doesn't work anymore. But having said that, I have a feeling that they're going to try and do something this weekend. Trump is definitely going to start tweeting and saying stuff. And, you know, people are talking about emergency rate cuts from the Fed. I don't think that's going to happen, but I think they're going to try something. So my feeling is definitely don't want to get long here, but if I was short, I would be covering for sure today ahead of the weekend. I think this weekend has changed compared to the last 3 or 4 weekends where the news, in my opinion, can be positive. We know this virus is everywhere. It's, you know, going everywhere. The contagion is ridiculous. So I don't think something in terms of the virus can scare us anymore because we expect it to be everywhere now. But I think there might be a chance of something positive. Just my opinion, it will still be a selling opportunity, but just what I think about this weekend.
All right. Well, that's it's good to hear. I think that you know, sorry, I was just in the middle of doing something. I'm gonna probably adjust some stops here. What do you feel about, how do you feel about the Fed at this point?
The Fed is interesting. We're pricing 3 cuts now before year end, and they're expected to act. You know, the market is expecting to act. The question is, they say they cut to 0%, they do QE. What does that solve?
They are doing QE, so don't worry about that.
I know what you mean. What does it actually solve? You know, this crisis now is first of all a supply crisis, right? Because everything has been broken, all the supply chains, and of course it's going to turn into a demand crisis because people are going to be scared and not going to be spending. You know what it's like. Car registrations are, you know, down 80% or whatever, you know, stuff like that. So what can the Fed do to actually help? That's a very good question, isn't it?
Right. You know, even if they enact some sort of just an emergency rate cut, that's just a short-term fix.
Actually, it isn't.
How about why don't they do what Japan did and come in and buy stocks?
Yeah, they could do that, yeah. But even if they cut rates, it's going to be a 2-day fix, literally.
Yeah. Well, I guess we'll see. And Steve, what are your thoughts regarding the Fed here?
The Fed definitely can't help in this situation, and they must feel pretty stupid because it's the first time that they're literally helpless. Because, so far they could try to face any slowdown issue by stimulating demand in the flawed way. They can stimulate demand by doing quantitative easing and cutting lending costs. But in this case, it's a supply side problem. So cutting rates under such a scenario, it's like throwing gasoline to the fire. What are you going to do? Give more money so the limited supply of items can be bid by more people or by more money? I mean, you just put inflation in the equation as well. So I don't doubt that they might try to do something like that because they will also face political pressure to do something. But do I believe that the market is actually going to, care if they cut like 0.25 or even half a percentage point?
Right, right.
I don't think so.
Well, I think the initial response would be they care.
For one day.
The knee jerk. Yes, right,
Yeah.
right. The knee jerk reaction would be that they care.
Why can't they buy stocks?
What's that?
Why can't they come in and buy stocks? They bought bonds. Why can't they buy stocks?
I don't know if the Fed would do that. I don't know. I mean, I don't think that the Fed will come in. I don't think that they'll.
BOJ does it.
Yeah, but that's the BOJ. I think it's different.
To be honest, we have to check that. I don't even know if they have the authority to do that. I remind you that when the Fed was created in 1913, didn't even have the authority to buy bonds. They had to amend that during World War I so they could help support with the funding needs for World War I. So I'm not even sure that they have the authority to do such a thing without, changing something congressionally.
I think the president would change it.
You think so? Nobody disagrees with that, obviously.
Just an executive order.
Anyway, well, hey guys, I'm going to pass it over to you. I want to thank everybody for being here with us all week long. I know it's been a very crazy week. And remember, if you haven't tried out ForexAnalytix, make sure you do so. And visit our webinar sponsor, Forest Park FX. They are the ones that will help you find a brokerage firm to best fit your needs. I'm going to let you guys go. Have a great one. I will not see you today on the Daily Roundup because we don't have them on Friday. Have a great weekend and be safe out there, guys. Trade smaller.
You too, Blake.
Thanks, guys.
you, Blake.
We have some numbers today. Core PCE, the Fed's preferred inflation measure. Remember, this is for January, so this will have been with limited effect of the virus. And
very limited, actually. Yeah, it's backwards looking.
Expected 1.7% year on year. What else do we have? Personal spending. Okay, we have a couple of things. Interestingly, we're talking about.
We also have Canadian
GDP. Yes,
yeah.
Absolutely.
Quarter on quarter and annualized, month on month. Obviously, Canadian producer prices.
Yes,
we also have, and Canadian data might be interesting because. I don't think the markets are going to care that much. I mean, the dollar is currently moving mostly based on, the flows we see in stocks because, this is the A game. But by USD CAD being, very well bid, having clearly broken, and we have been talking about this formation here. I mean, we broke through it. If you remember, I had been saying that I think we can make it all the way to 135.60 if we broke through that. So, weak Canadian data, I think are just going to, put more fuel to USD CAD, and we might see, the move higher just accelerating. So other than that, I don't think that we're going to see much of an effect on the dollar per se based on the data that we'll get. But anyhow, let's see what the market gives us.
Yes. Okay. So we have about 20 seconds. Yeah, we had some other data this morning, but really, who's going to care about general unemployment moving a little bit? It's like, whatever.
Yeah. Currently, I think the market doesn't pay attention to any of that. I mean, they just pays attention to risk off and the sell off in the markets. I think that's the only thing that matters currently, unless we start seeing some really bad data, in which case I think the market's going to care even more. Okay, US Corp PCE a little bit lower.
1.6, yeah.
Personal income better, US consumption a little bit lower.
GDP Canadian better than expected. 0.3
Canadian
month on
producer
month.
price is lower, negative 0.3
Yeah.
versus positive 0.1 expected.
Yeah,
Canadian GDP month on month indeed better.
Yeah, I'm guessing nothing's really
Yeah,
going to move on this.
I'm also guessing that, you know, nothing really is going to happen based on the data.
We were talking about the Fed before, and, you know, I had a conversation with a friend of mine, and I was saying exactly what we're saying here, and he goes, okay, so what do you think should be done? You know, how do you actually tackle this situation that's been brought in over all these years? And, you know, I've been thinking about it, and it's my opinion, but the problem that we've had for all these years is that the risk is not priced correctly. When you have, you know, junk bonds yielding 3%, and when corporations can borrow at near zero and buy back stocks and all this stuff, it's just distorting everything. So my opinion is the number one thing they have to do is allow risk to reprice on its own, which means allow the yield curve to go wherever it needs to go. Exactly. And then everything will get fixed. The problem is you will have like 2-3 years of pain. Yeah, exactly.
Intense pain.
Intense pain. But that's how you get out of it.
We're going to eventually get that, even with what they're doing, with the only difference that you're going to get a lot more social unrest the more you wait.
Yeah, yeah.
But,
I mean,
you know, unfortunately, they're playing the short game, Stelio. They don't care to play the long game because they, you know, their actions are influenced or even indicated by politicians, and politicians, you know, only look ahead.
Yeah, 4 years, or 5 years.
4 years at a time. Yes, exactly. 4 or 5 years at a time.
What I think should have happened is after the 2009, where things kind of stabilized, they should have then allowed markets to reprice, you know, and everything, you know, eventually come to a nice balance and equilibrium. But no, you know, with the first sign of trouble, they just, you know, cut rates, QE into infinity, QE3, QE4, QE whatever. You know, it just doesn't solve any problems.
QE3, no QE4.
Yeah, no, not QE4, exactly.
Yeah.
So, you know, that's my humble opinion. You know, people might disagree. That's what I think. And, you know, always when you're getting out of a bad situation, you take some pain, always. But then the good times come. But if you try to avoid the bad times, then eventually it's going to be
the drug addict example is the best example in this case. You know, you're addicted to drugs. You need, you know, to cut off them to actually, you know, have a life and not die from it. You know, I'm assuming that, you know, going off drugs is not a pleasant procedure, right? Obviously, but, you know, you have to go through the pain in order for you to be back to healthy.
Speaking of that, Steve, you know, this opiate crisis is giving me a real bad headache.
Which crisis? Sorry, what? Opioid crisis?
The opiate crisis is giving me a headache.
Yeah, that was another of the financial excesses, in essence, started back in 2001. The opioid crisis in the US.
That
was horrible.
Yeah. Anyway, that's
getting so many more or less healthy people addicted to opioids for no good reason.
Yeah.
Anyhow,
cure their headaches.
Yeah, and create a lot more problems. Yeah. Now, in my opinion, the biggest development that we've had today, you know, besides the obvious, is the fact that not only USD yen has now moved back below 110, which was the breakout area, which, as I had said in advance, if we did move below 110, then the situation, you know, changed completely for USD yen, because now we not only had, you know, a breakout from a multi-year trendline resistance, but we had a completely a complete 180 reversal following that, which now leaves this this little period as a false breakout to the upside, and that is a very, very bearish signal. So not only we invalidated the now false breakout from 110, but we're now in danger of actually breaking below this ascending channel. As you see, 50 DMA and this ascending channel more or less in the same area. And if that's the case, then we're talking about much lower levels. Amanda, for example, I know she was all over this. Blake was also looking during the past few days. I didn't want to have anything to do with it as long as it stayed above 110, but it now starts looking very, very bad for those that were trapped.
Gautam Batra sold the high up there.
Yeah,
See, we have some smart guys here in face.
That
nice
was actually
trade, Gautam.
that was actually, that needed, some some big
testicles.
Cojones.
Yes.
Yeah,
kudos, good for you. So now I don't know if we're going to manage to hold this area over the weekend, but one thing I know for sure is that below this area I just see a pocket of air until we actually make it down to 105.50. So another 300 pips of downside seems very easy to me once we clear this channel trendline support with whatever that means for any other yen pair, obviously, right? I mean, we've seen big moves in yen pairs. As expected, I said that I like this Kiwi yen and the Aussie yen both to the downside. I was skeptical as long as USD yen stayed above 110, but once it penetrated through that, they just collapsed. So Aussie yen, near the multi-year lows, Kiwi yen not that close, but not that far either. I mean, we've now broken and already fulfilled the target for this rectangle. So, as long as risk is off, Aussie yen and Kiwi yen, I remind you, two of the most traditional risk-off pairs. So, last time we had, a prolonged risk-off environment, one of the best ways you could play out that thesis through FX was being short the Aussie and the Kiwi yen. Now, Blake briefly mentioned, and I wanted to extensively go through the euro pairs because all of them are at quite interesting junctures. First of all, euro pound has finally clearly broken above this descending channel, so that opens up a lot more downside, a lot more upside. We might have a short-term pullback, but I do think that we might see much higher levels in euro pound now that we've actually broken through that, especially if we go above 86 cents, because if you isolate this area of the chart, you can view this as a rectangle. I mean, we had a double bottom at 82.75, right? You can see it here, almost to the pip at double bottom. So 82.75, and if we do break above 86 cents, that actually triggers that, which that implies a 350 pip move to the upside. So if you want, you can try to fade this range. Let me mark it in green actually, so you can easily distinguish it. So here is the range, and here's the rectangle I'm talking about. There it is. So you can try to fade this move from 86 cents, and it might work, right? So something like this, and it might work, but keep in mind, we break above 86 cents. Basic technical analysis theory implies another 350 pips to the upside. So I think euro pound one to watch. Euro Aussie and Euro Kiwi, after monstrous moves to the upside, just look at this. This is Euro Aussie, right? I have two trend lines here, both of them of significance, both of them parallel to this trend line support. So it's, we're talking about a long-term ascending channel. You can take either of those two trend lines as important. We haven't managed to close above the first one on a daily closing basis. We've spiked to the second one 3 times, including today. So obviously quite a nice area to try to fade this strength. Now, this might also indicate some type of a rebound in stocks as well. We're going to go through stocks in a while. So Euro Aussie at key resistance area, Euro Kiwi at key resistance area. Look at this. long-term symmetrical triangle. We spiked above the trend line and tested this previous high intraday, but we've now already receded within the triangle. EuroCAD spiked exactly, look at this descending channel, which dates back to quite the beginning of 2018, right? So today we spiked again to test this channel trendline resistance, and so far during this first test we got rejected. Euro Mexican peso, you know, quite a massive move higher. I mean, this pair has moved within like 6-7 days 8%, which is, sorry, more than that. Magnet, come on. 9.5% within, like, you know, what is it, 7 trading days or whatever, which is, you know, a massive move for FX, right? Getting rejected from now from the 78.6. So, you know, euro pairs in general, euro NOK is the only one that is actually breaking out. I mean, I really didn't expect that this could easily happen. You know, this was a nice, massive ascending wedge, but the rest of them are testing, you know, important resistances. So, you know, I can see a likely pullback, you know, for all of those if we see some type of a respite on behalf of stocks. Now, Blake already covered the vast majority of indices. I just wanted to show something that has to do with the Dow Jones. Keep in mind that taking into account this massive wedge in the Dow Jones, massive ascending wedge overthrow, which is very, very usual in wedges to see, you know, a period of overthrow, and, you know, we broke through it. Keep in mind that that would imply a corrective move all the way back to 21,700, right, to fully retrace this wedge. And this is something that, you know, you should keep an eye on when you have in mind, you know, the big picture. Keep also in mind, if we're talking about the S&P has already cleared this trend line support. I expected yesterday that we might see, you know, a little bit more of a rebound to sell, and, you know, then move closer to 28.65, but, you know, that was just massive. And, you know, I tweeted like 3 days ago that, you know, this is not the environment that, you know, people that have gotten used to buying a couple of days of a dip should be attempting to buy the dip, because it's extremely dangerous. Now, I don't know how many actually listened. You know, this is a market that you should be selling any kind of rebound you get from this point on. Even if this is a corrective move lower, even if we assume that today's low is, you know, some kind of a low, then we're still missing at least one leg to the downside, right? So any rebound towards 3,000, 3,080, 3,120, I doubt it that we're going to make it that high, but any type of a rebound like that should produce another selling opportunity. I think, judging from the momentum we've seen in this first leg lower, even assuming that today we found some kind of a low, which there is absolutely no guarantee for that, right? I would then be looking for a move towards 2700, 2740. 2740 is actually the 61.8% fib from the low we got December 2018 to the all-time high that we had just 8 trading days ago. So these are the areas I would be looking for the index to move next. So bottom line, I'm not looking to be buying rebounds. I'm looking to be selling. I mean, I was short from 33.78 to 31.20. I thought I will get an opportunity to sell again higher. That wasn't the case. Now I'm going to feel lucky if I manage to sell again from where I left my previous position at 31.20. So that's what this market is telling me. Now, having to do with the DAX also a very clean ascending wedge here. You can see it clearly. That would also imply a full retracement of that wedge. We're not that far away actually in retracing this wedge. But still, that would mean making it down to 11,250. Okay. So, you know, I don't see any of the indices that makes me feel like, you know, we had this massive move lower. Keep in mind, that was the fastest 10% correction we've had in history. Usually when you see statistics like that, that's not a good thing. That's not something you should be trying to fade. We have a friend here asking about the FTSE. And one of the scenarios I was actually looking for in the FTSE, and I had drawn that a long time ago, is that this could be a diamond formation. You can see it, not that beautiful. And diamond formations can be powerful reversal formations. And look at this. FTSE tested earlier today lows that we hadn't seen since 2016. Now that tells you more or less all you need to know. Same deal here. You know, I would be looking to sell any rebound to any decent resistance area. Nikkei collapsed as well, lower, currently breaking through the 61.8 of the last move higher. As you see, you know, that 24,500 area, you know, got price rejected multiple times. I mean, we got rejected initially January 2018 when all the indices turned lower. Back then, we had that exuberant move higher. We then saw a little bit higher levels in September 2018, and we had now been testing that area, you know, multiple times since last December, when, you know, unable to move higher, we finally collapsed lower. So, you know, whichever index, look at this, by the way. This is, and I had shown this on this webinar some time ago, this is the Australian stock index. Just look at this channel higher, which dated back 2009, right, when it bottomed. And overthrow, and look at this. I wonder how many people got trapped in the wrong side of this trade. Up there, I'm assuming quite a few, right? That was an 11-year channel. We broke through it once. We, you know, went back below it. We broke through it twice, you know, left behind a huge RSI divergence, and boom. I mean, it has literally just collapsed. Steve, could you move straight to a new high in SPX from a technical perspective? No, I can't. I mean, from a technical perspective, I can't possibly see this leading to a new high straight from here. So making some type of a V-shaped bottom and going to new highs. I think that after the huge damage that has been done, technical damage, finding a low, if we assume that this is a correction, because keep in mind that we have prepared you for quite some time. If you remember, since weeks ago, we said the following, that if this market, due to, let's say, coronavirus fears or whatever the trigger is, start plunging lower, getting so close to the US elections and even closer to the Democratic Party, you know, ending up selecting a candidate, with the stock market being weak, the market is going to start to have to price in some probability of a win on behalf of the Democratic candidate. The problem is that currently the main candidate from the side of the Democrats is Bernie Sanders. And, you know, Bernie Sanders is undoubtedly going to be bad for the markets for several reasons. I mean, probably even himself can, you know, attest to that. So, you know, with the stock market being so much under pressure, sooner rather than later, the market is going to have to be forced to price in some possibility of him being the next president, even if that's a 20% probability or 30% probability, which is still rather low, right? I mean, if somebody thinks that Trump has a 70% chance of winning the next election, that is, he's still, the favorite by far. But still, the market has to start repricing in some chances of, Bernie Sanders being the next president of the United States. And that would bring even more pressure to the markets. And if the markets keep tumbling lower, the chances of Trump getting reelected are going to drop even further. So then the market will have to price in even a higher probability of Bernie Sanders being the next president. And that should make the markets reprice even lower. And that, you get where I'm going. I mean, this is a vicious circle. The lower we go, the higher the chance of whatever other candidate is going to be the next president. So the market has to go even lower, because between Sanders and Trump, there is no question about it. The better one for the markets to stay elevated is Trump. As simple as that. I mean, he's promising still some tax cuts, etc. Bernie Sanders is even considering things like, in essence, forcing companies to issue new stock to distribute to employees, which, by default, that is diluting, stock price. So that, as simple as that. So, we'll have to see how that works, but I'm telling you that I'm seeing all the elements of a perfect tsunami coming here. In Athens, so far, we have only one confirmed case of the coronavirus. Yesterday, I took my son and his nanny, because I had something I needed to pick up, and went to one of the biggest malls in the area, and it was empty on a Thursday afternoon, which is, day that, shops are on and open, and the weather was fine and everything else, and it was almost empty. Imagine. And we only have had one confirmed case of the coronavirus in Athens, and in total we so far have 3 in Greece in total. So imagine, we're talking about a big economic disruption, and in the case of the US, that comes at the worst possible time for those that were hoping in a Trump re-election in order for the stock market to continue moving higher. Anyhow, this market was priced, the usual expression is priced for perfection, but it wasn't priced for perfection. It was priced for rainbows, unicorns, aliens landing on the planet and gifting to humans, new groundbreaking technology, and, I don't know, whatever else. So as you understand, when a market is pricing in rainbows and unicorns, there is a big problem with whatever negative happens, right? Because then repricing has to be extremely violent. Let me go through your questions. Good morning, good morning, good morning from Brazil, good morning. Let's go to 1,800. Yeah, I mean, with the pace we've been moving lower, anything is likely. Hi Dale, can you please make a further comment about the treasury chart? You see a top there. Okay, treasury chart. By the way, USD yen at lows of the day. So as it seems, USD yen has a decent chance of actually closing the week below this channel, and that is definitely going to be very negative. So here is the 10-year treasuries, and now we're clearly trading above this trend line resistance, and as you see, we're getting quite close to the all-time highs right there, more or less confluencing with the 161.8% fib of the last correction. So let's make a zone here. Okay, that's the area. So so far no indication of a pullback. Yeah, we are very overbought. I mean, RSI, daily RSI is above 80, so we should see some type of a pullback, but that pullback is very likely to produce a move like this. Okay, So as long as we trade above 132, I really don't see why somebody should be turning bearish here. And this week is obviously some type of a, probably some type of a false print here. There's no chance, of course, that bond yields went back to zero. But we're currently at 1.2% in the 10-year.
I bought them down there for a day trade.
I think that
0%.
if somebody managed to get a bid down there, good for them.
I bought it down there. I have I paid 120 at it.
That was a great trade, Coach. I have to give you
I
that.
did it with my cursor.
Yeah,
I dragged it down, bought it, and then dragged my cursor back up.
Probably one of the best trades ever made in the history of.
I'm going to be in Barron's
fixed income, right?
Yeah. I'm the bond king now.
Yeah, indeed.
Who's
If
Bill
you put
Gross?
down there, you are the bond.
Yeah,
you are the bond king. Yeah,
Yeah.
no question about it. So let me go through some of. So yeah, no respite yet. Now, question about Euro Swiss. Listen, the problem with Euro Swiss, obviously, the Swiss franc is benefiting a lot. I mean, S&B would wish that wasn't the case, but there are a lot of flows going through the Swiss franc. Clearly, despite being in a downtrend since retesting the previous floor at 120 in April 2018, despite having seen this move lower, don't think that the S&P has not been intervening on the way. I mean, I'm pretty sure that they have softened the move lower as much as they could. And the fact that, despite all that, any little rebound is being immediately sold from the market tells you anything you want to know. So bottom line, I think it's very, very tough trying to buy the Euro Swiss. You might get lucky and get to buy it like ahead of some kind of a spike due to an intervention from the on behalf of the S&B. But other than that, this slow drift lower can continue, for a lot longer. So, personally, I wouldn't be buying it. COVID cluster in USA would probably scare. Yeah, I mean, scare. People are already scared. Now, do I think that, being that scared is really rational? No, I don't think so. If I did think so, I wouldn't be out with my son yesterday in a mall. Although actually by seeing the situation in the mall, probably it's safer than my house. I mean, it was like a huge area that was empty. Why have they been absent already? Maybe they know something we don't. Yeah, you're referring, Scott, you're referring to the Fed, because I remember I saw your question when we were talking about the Fed. I really think the Fed can't help at the moment. They can only show desperation, because really the current issues are not fixable by cutting rates by 25 basis points or 50 basis points. The problem is not demand at the moment. Fed is essentially buying stocks by loaning money to banks, businesses. Yeah, no question about it, Ziggy. No question about it. I mean, we've seen that there is no trickle-down effect to quantitative easing and loose monetary policy, because the vast majority of the benefit stays at the very top, right? And yes, they're using a lot of that money to buy stocks. But they talked about the Fed doing it directly and not indirectly, because indirectly, yes, they are in essence enabling buying of stocks. The smart approach is to wait and see what the new case numbers are in the virus. Selling probably continues into Monday due to media. Yeah, might be the case. I mean, you shouldn't be betting against this bear market. There is a saying in such moves that usually the market follows a slope of hope, but so far every attempt of a little rebound that we've seen has been met with massive selling pressures. I mean, yesterday we had almost 1.2 thousand Dow Jones points lost in a few hours. Biggest, by the way, point move in the history of the index, right? not percentage-wise, but and we are already working on having I think the fourth worst week in the history, or something like that, percentage-wise in this case. It seems like Trump should put massive power towards a vaccine. Yeah, but it's not that they don't want to make a vaccine. I mean, they're obviously trying to, but that doesn't mean that they will succeed in doing it immediately. Steve, could you? Okay. So, is David with us?
Yes, Steve.
Okay, perfect.
Okay. Are you?
So let's see what he
bring him on?
thinks.
Okay.
Yeah.
Thank you, Steve.
I think
David?
that the only objection I have to David's outlook for the markets, objection. I mean, I'm not that sure as he is I think that he thinks that they're going to manage to reinflate the bubble from here before it finally bursts. I'm not that sure.
Well, we'll find out.
Other than that, I'm 100% on the same.
I'm sure that made his day.
I'm 100%, on board with his thinking.
Okay, he's one of the greater thinkers in the market, in my opinion. So, David, I'm unmuting you. Welcome back to Face. It's been way too long, and I'm going to have Steve stop sharing his charts so you can show yours. There you go. So, David, can you hear me? I've unmuted you.
I can hear you loud and clear. Can you hear me?
Yeah,
Got you, buddy.
Welcome.
It's great to be here again, guys. Thanks for having me on.
Are you kidding me? What a great way to cap off an historic week with someone who is one of the best at putting together the whole jigsaw puzzle of all the different instruments relate to each other and the economy, the fundies. You're one of the best, David. And this was my narrative coming into this week. And then I want to see what you have to say. I did in a little poem. Corona, Corona, fear that I'll own ya. Born in a lab in China, spreading so I'll find ya. No one is safe, not even a king, and I'll be the excuse for everything.
Excellent, well said.
You can change the ending by saying, "And I'll be the excuse. I'll be the pain for the bubble to burst."
Okay, well, that'll
We'll
be
see.
my next edition. So, David, there's a green share box here in Zoom. If you hover your mouse over the drop-down menu, and then you'll be able to share your screen. You see it?
Bear with me 1 second.
Okay.
It's the only colored button, actually.
And
Yeah, I'm trying to bring it up right now, and for some reason, it's launching again. It says. I had you a moment ago, so I don't.
Okay, it's just a little green
It
box
might be
that says
minimized at the
share.
top right of your screen if you clicked on something else.
Oh, there we go. So where is it? Up on the
Should be at the bottom, actually, to begin
bottom?
with. Yeah,
And it's a
at
green
the bottom
box.
of the Zoom page.
Share, I got it. Finally.
Yeah.
Showing my age there, guys. Thanks for that.
Okay. Hey, what good is anything until it's shared with another?
Excellent.
So, David, my question to you, what makes you think that this was not the bubble pricking, which is going to make it very, very tough for them to reinflate? I mean, what makes you think that they can reinflate it for one last time?
Let them get the share first, Steve. I'm still not seeing your screen, David.
Oh, really?
Yeah,
okay.
so
it should give you a second screen asking you which screen you want to share, actually.
there we go.
Now something is coming through. Yep.
Okay, we got you, David. All right,
Okay.
so Steve wants to know how you believe the Fed could rescue this thing.
Okay, I'm good. We're jumping ahead a few pages,
Okay.
but let me just put this up behind. So it's background to what I'm
Okay.
about to say. So, from my perspective, the Fed, this entire rally since not just 2018, since 2009, has
Right.
all been driven by artificial stimulus. And I would actually counter, and sorry, Steve, I missed your comments at the tail end of your presentation a little earlier, where you said you differ with me. The Zoom was loading, and it just cut you off for that like 10 seconds.
I said that we're thinking in the same type of manner. We both believe in Austrian economics more or less and sound money, and I'm 100% in the same school of thought as you are. Our only difference in assessing the current situation is that I'm now giving, especially ahead of the US elections, a decent chance that this might be the prick that burst the bubble, while you're still quite optimistic that they can reinflate it for one last time. And I'm asking, what makes you think that? I'm not saying that it can't be the case. It can, but I see you're quite confident about it, and I want to know, because I respect your way of thinking and your analysis. I want to know, what makes you think that they can manage to do it.
Well, it's again, as I was just saying, thanks for giving me that quick update. So if you look back, going back to 2018, I think we'll agree on that, and perhaps we could have more of a debate since 2009. But certainly, from my perspective, this entire rally has been driven by the Fed and other central banks to more or less a similar extent. And the latest drop is just further confirmation of that, because the FOMC minutes came out on February 19th, and they stated that valuations were elevated and were planning to taper repo interventions in May. And that alone, and then subsequently the stock market drops. Now, compare that to the cover story, I'll call it, that the coronavirus is responsible for this. The coronavirus has been around for a couple of months now. Some would argue as early as November. But the number of infections, the number of deaths has been climbing steadily, and there's debate over whether the numbers are correct or not. But this is my point. Did suddenly everybody wake up on February 19 and decide that coronavirus was all that mattered? You just suddenly your alarm clock went off, and you said, "Oh, the world's going to end, coronavirus."
The excuse for everything, right, bro?
Yeah, I don't buy that argument. Whereas, on the other hand, you had the FOMC minutes come out where the Fed says, hey, I know we had your back before, and that's why markets have been climbing ever since December 24th of 2018, but now not so much anymore. We're going to taper our liquidity injections into the market. Now, if you are like me and you believe that liquidity is all that's been driving this market, and then on Feb 19 they come out and say, hey, we're pulling some of that back, like any Ponzi scheme, and I will say Ponzi scheme, when those cash flows into that Ponzi scheme either stabilize or fall, even worse, fall, what happens to the Ponzi scheme? It collapses.
Yeah. Done.
It implodes.
Collapses.
Yes. So the Fed was essentially saying, we're printing money beyond belief and injecting that into the repo market, increasing our excess reserves on balance sheet again, to ensure that we retain control over the short-term rates, etc. But now we're going to ease off on the gas pedal. And what happens? The stock market dumps. That is the reason for me. That's the trigger. That's the catalyst. We can debate the background. We can debate the fundamentals, and coronavirus included. I'm not belittling it. It could be, Armageddon financially and socially, but
it definitely will affect the economy. I mean, we have so few incidents here in Greece. And yesterday, as I said before, I went in one of the biggest malls here, and it was empty.
Yeah, but I will also cite yesterday somebody was flying out of LaGuardia Airport, and you saw like 2 people wearing masks. Nobody else was wearing masks. So
from those that actually went to the airport, though, you have to take that into account.
Yeah, there were only 3 people there. Yeah. No, but again, to follow on your point, Steve, it's a good point. But since when has the economy and the stock market been connected?
Oh, not lately, for sure.
I would argue since 2009. I mean, this market has been doing its own thing. And that's what my comments are focused on the market. I agree completely with you regard to the economy. But I like citing a tweet, I think it was QTR posted about a month ago, basically saying that, you know, the mankind has come to an end due to the coronavirus, but there's a printing machine in the basement.
Yeah, there's an algo, he said, at the basement, still beating up the S&P. Yeah, I saw that. It was hilarious.
The Dow's hitting new all-time highs. But,
yeah.
you know, but
David, why would the Fed, you know, most Ponzi schemes don't end intentionally. They end because they can't find any more bag holders. So why would the Fed intentionally sabotage their own Ponzi scheme again?
Well, first of all, I don't think they've intentionally sabotaged it, maybe in the short term. But this is where it goes to Steve's earlier point, you know, about my optimism.
They'll be back singing Kumbaya with Yellen and Bernanke again?
Yeah, let me paint a scenario, because I hear this a lot, especially on Twitter, about like the Fed can't let this go much further. They won't be able to bring it back. I disagree, strongly disagree. Let's look at this for a second. Look at Tesla. Just use Tesla as an example. Their stock price just shot through the roof recently, and one of the principal reasons for that was the short squeeze. You know, people were massively short Tesla, and they got squeezed to high noon. You saw that methodology used in the stock market by the Fed and other actors to pump the prices higher, basically squeeze the shorts out, and they've become very effective at it. Let me ask you, do you not think that if this market drops down to my primary target of 2,600, or even to my original target, which you may remember, Dale, which is back down to 2,100,
that's the megaphone line.
Yes. Imagine we fall all the way down to 2,100. Mm-hmm. The sellers may or may not be exhausted, but imagine how many shorts there are out there. And then the Fed, agrees to QE, bring back full-blown QE, potentially MMT, which they've said like is nonsense, but you know, in a crisis and under political pressure, they agree to do that, and then they also enact new measures such as buying equities. While the market is record short, you don't think we could see the most historic short squeeze you've ever seen?
From 2,100 to 4,200.
Yes. Okay. I mean, you squeeze the shorts, it gets you to 3,000.
I'm 100% with you, with one little objection. Don't you think that under the current circumstances, which is with the U.S. elections coming close, even a drop even to your first target that you mentioned should start hurting Trump's chances of getting reelected, and wouldn't that by default force the market to start pricing in a president that is a lot less friendly about, about the stock market, like, Bernie Sanders? I mean,
but by then it could be sell the rumor by the fact if Sanders won.
And this is the other thing with regard to Sanders. Yes, and this is another thing with regard to Sanders and the socialists. Look, these are the guys that are pounding the table for MMT.
Oh, and absolutely.
If you start flooding the economy with money and start sending checks in the mail to everybody, on top of that, you're buying every asset out there, student debt, you name it. On top of that, equities. I would actually expect the market to go roaring higher, at least in the short term.
Might be the case, but not in dollar terms anymore. You know what I mean, David?
Not in real terms.
Yeah, if that was the case, I would expect the dollar to start a massive move lower.
Yes. We're on the same page. That's the way the end game plays out, in my opinion. It's basically hyperinflation. By doing this, of course, it's all nonsense. You're going to print the dollar into oblivion. But what other choice do they have at this point? And we've been talking about this for quite some time. U.S. unfunded liabilities are coming due this year in a big way. And they're already massively indebted. Deficits are over $1 trillion per year. And you've got Lagarde calling for fiscal stimulus in Europe. You're going to expect the same in the US from the left in particular. I mean, it's just going to get worse. How are you going to pay for all this? Well, hello, Fed. That's what they're there for. We're just going to go down to our printing press in the basement and we're going to buy another printing press beside it, and then we'll buy 4 more. It's Weimar Germany all over again.
As I've said, there are 2 ways. The honest way, which we know that today's politicians would never follow, which would be, tell everybody,
default.
listen, we made a big mistake. We have to, to have a huge haircut, but at least, we're going to sustain, the purchasing power of the currency, and the dishonest way, which most probably politicians are going to follow, which is massive devaluation of the currency. So you actually pay what you promised you would pay, but it's not worth anything anymore.
There you go. I can't see Trump going for the former. And I'm with Jeff Gundlach. I believe the US is behaving fiscally more like Argentina than Japan. So I'm in the camp where they are going to print the dollar into oblivion. That's the sacrificial lamb to keep bond yields down and to pump the stock market.
That would, though, also mean an abrupt end to its status as world's reserve currency, right?
Oh, this is the end game we're talking about, yes.
Yeah, because who's going to accept it anymore as world's reserve currency if it starts, dropping like a stone?
Yeah, you're talking about global monetary reset.
Yeah, of course.
You're talking about new global currency, but again, that's where I believe this is all going, is that we're going to get a digital SDR or some other supranational currency that basically becomes the new global reserve currency. And in order for that to happen, the dollar has to be sacrificed.
Yeah, it is a very likely scenario.
Yeah, so go ahead, David.
No, I was just wondering, is there any, I know your, metals will do very well in an environment like that. Is there any fiat that will do well? Will the euro and the Aussie, just for fiat trades, be the beneficiary of this dollar collapse?
The gold-backed ones will be.
Okay.
Chinese yuan and the Russian ruble are looking extremely attractive these days.
Okay.
No, I would try to stay away from fiat, because if you look at the recent appreciation in gold, as well as it's done in the dollar, it's hitting record highs against the euro, Canadian dollar, the Aussie dollar. So I don't think that trend, absent the short-term drop that we're incurring right now, I don't think that trend is going to change. And so I honestly couldn't recommend any fiat currency. I'm not with Peter Schiff in that, but I'll put some money offshore. No, I would just go to the metals. They are currencies in and of themselves.
Okay.
Yeah, that's my 2 cents on that.
So hard money.
Hard money.
Yeah.
Hard assets are the only place to be. China and Russia, I've been saying since 2015, follow the smart money. Those guys have been loading up in gold and silver since 2008, at least. And they're not doing it because they think it's shiny and pretty. They're doing it for a reason. And it's insurance, yes, but what would cause the biggest appreciation in value of gold in particular, and of course silver and the miners?
Because you have to back currency.
The collapse in the dollar and fiat currencies in general.
Mm-hmm.
And he who has the gold rules. So I believe that that's the rationale, that they see the same things we see, the debt on the US books and so forth. And I keep coming back to this slide from Bridgewater and the CBO, because I think it's the most important graph. I haven't got the updated version, but this, where they show the debt to GDP, the total debt to GDP. We keep talking in terms of 105% and so forth, public debt to GDP. Back in 2016, and given the deficits that we've incurred since, this is probably a lot higher. It's over 1,000% of GDP. If you add everything up, the amount of debt in the US is over 1,000%. That's a banana republic.
The US only non-funded liabilities, I think, has something like 120 trillion maturing within this decade. It's nuts.
Yeah, that's the number under Social Security and Medicare right here. It's got the blue
nuts.
and it's nuts. So how are they going to pay for all this? Either they outright default. This is not rocket science. It's like, you're overdrawn on your credit card and you owe the bank on your mortgage. How do you pay for it? You either default or you go out and get another job and you pay it off. But the Fed has, the US government has another option. They can literally print the currency to pay it back. And that's what they have always resorted to. I hear the talk of Jubilee and so forth. I don't see how the Chinese and the Japanese are going to agree to that, given that they're huge creditors. But it's always easier, and the silent method is just to inflate it away. And that is the option that governments and politicians have typically always chosen. And that's what I expect them to do now. I mean, that's what we see the central banks doing, you know, for the past 30 years, but especially in the past 10. They're just printing the currencies into oblivion. I don't expect this to be any different. But I would like to, you know, we're talking very high level here. I'd like to go back to the S&P and just quickly state, you know, this is a massive move, and I do believe that the Fed is in control of the stock market. You know, economy is another thing, but in the stock market, and that if they let this thing drop to 2,600, or even perhaps my original target, which was around 21 to 2,200, and then they come out and they start printing full-blown QE and double, triple their balance sheet, yes, they can drive this higher. But to your point, Steve, I mean, 6,000 on the S&P, what is that in real terms when you've just devalued the currency by 50%? I mean, it's, what, 3,000 again? What if you devalue it by 75%, then you're down to 1,500? You know, my point is that, yes, they can pump the stock market higher. They can simply just turn on the printing presses, as Bernanke said back in 2002. But in real terms, where the money is to be made is going to be in gold and silver if that happens.
Do you think that this week's action, David, in the dollar is important for a cyclical, maybe secular turn, the reversal to the downside we had this week in the Dixie?
Well, let me answer a question with a question, which I hate, but it illustrates the point. Every jingoist in the US has said that in the next crisis, the dollar is going to take off because capital will flow to the safest harbor, which will be the US, and the dollar will go higher. Now, maybe just short term, but at least initially, what does the dollar's fall at the same time as the S&P's dump tell you about the dollar's prospects? It tells me that everybody anticipates that the Fed is going to print. Okay. Because they have no choice. The only alternative is collapse. Because this is a Ponzi scheme. I mean, if they don't print, well, why would the stock market go up? To your point, Steve, you've got the coronavirus, which has shut down ports around the world. People have stopped spending; they're locked in their apartments, etc., etc. Why would the stock market go up? There is no reason. It wouldn't. There is no reason.
Especially from the disvaluations that we've. I mean, as I was saying earlier, this market wasn't priced to perfection. It was priced way beyond that, right?
Yeah, I was watching the Disney Channel for financial news. Yes.
Yeah.
So yeah, it just illustrates my point, which is that the only way this market goes up is if the central banks print it higher, and unless Trump is willing to throw in the towel, that's precisely what I believe they will do. Will they do it tomorrow? Not necessarily, but if they do it lower, and they've used this short squeeze strategy very effectively, and I'm not saying this is definitive. This is just one scenario. You could be right, and it collapses now. The depression has already started, and we don't even know it. But I'm not so sure. I think that we could see a drop to those levels, to point out 2,600 or 2,100, and then the Fed comes back to town. And despite what others are saying, I believe they could print it higher. And I think that the dollar's weakness recently indicates that too, that's what the market expects. Ultimately.
Okay, interesting. All right.
So that's my principal view with regard to the...
You were talking, so really binary, you were talking about in a tweet. So basically, when you think about it, everything's gone up together, and really the only place that you had any cover this week were in treasuries. Gold, even gold is lower on the week. Some people saying margin calls. Silver is down $2 from the highs, so it really didn't serve its purpose as a hedge against risk off. So, and isn't it possible, David, that if China's problems continue to deepen, that, I mean, they own gold from $800 lower. Mm-hmm. Couldn't they sell a little gold and then buy it back cheaper if they need to finance whatever they're going to do to bring their economy back?
Sure, but all evidence to this point suggests that they will do the opposite. That they will
Just keep buying it.
sell their dollars and buying it as it goes down. Yeah, they'll take and other central banks too, including Russia in particular. Actually, whenever I talk about gold, I always have this one caveat that I always cite, that is the 2008 scenario, where gold fell 30% in 2008 from March until October. At the same time, the stock market dumped. Now, it did start to rally ahead, and I show the chart here. It did start to rally ahead of the bottom in the stock market because the gold investors anticipated QE, and there you have it. There's no reason not to expect the same scenario to play out if indeed gold keeps going down. One of the drivers of this, by the way, the drop in gold, was a spike in real yields. Now, back then, you didn't have the Fed coming out and saying that in the event that yields go higher, we are considering capping those yields, much like Japan has done, which Brainerd alluded to on the 21st. If you are capping yields, say at 2%, and they start printing and inflation starts going through the roof, per our earlier scenario, what happens to real yields? They dump. If you cap the nominal yield, it can't go any higher. You cap it at 2%. So you're printing all this money just to buy the debt and keep it at 2%. But meanwhile, inflation starts to take off because we've got MMT running in the background where you're flooding money into the economy. Real yields are capped and they fall. And there's an asymmetric risk to real yields. So sure, in the short term, you could see a 2008 scenario where gold and silver pull back. But for me, it's just a buying opportunity, because unless the Fed and the politicians are willing to allow the world economy to collapse from this point forward, which I sincerely doubt, the only option they have is to print. And if
they can cap yields, are you saying they could prevent? Because I actually think the bond market's an even bigger bubble. It's a bigger market. That they could prevent a bear market on the long end of the curve, a big bear market where yields spike up on the long end.
Absolutely.
Started deepen a little bit. So they can't prevent a bear market in sovereigns, can they?
Yes, they can. Absolutely, they can.
Okay,
but Dale, let me finish that point. I'm not just going to leave that out there. Oh, David Brady says, that the Fed can cap yields, betray economic science. No, if they do, and they can, there's one casualty, and that casualty is the dollar. Like, they can print as many dollars as they want. As Steve mentioned earlier, and this is exactly the same scenario, the holders of those treasuries will get their money back, but it won't be worth squat, because the dollar is being printed into oblivion. And that's what I mean by what's gold and silver worth when that happens. I'll pick a number with a number of zeros behind it.
So the big short is really the dollar. More than the stock market, more than the bond market, the big short is the dollar.
That's one way to put it. I would say the big long is precious metals. Yeah. But yes, I've been on board myself, and the likes of Luke Groman have been saying this for years now. That I don't see any other way out. Honestly, I mean, even in a Jubilee situation, that is effectively a default, and the dollar is going to head south. In order for a global reserve currency, a supranational global reserve currency, and I'm not putting on a tinfoil hat when I say this, but everything is pointing in that direction. They're all talking about digital central bank currencies, and there's going to be a digital one world currency. That's not going to be FedCoin. It's going to be the electronic SDR. It was built for that purpose. Well, in order for that to happen, the only way you're going to get the Americans to agree to it is the destruction of the dollar. If the dollar collapses, then of course they're going to agree to an international currency.
Yeah, because there's going to be pressure from citizens to get in on something more stable that will actually stabilize prices. Yes.
Exactly. That's the way. That's the mechanism to make this happen. Now, do I know the timing of this? No, but it's better to be early than late in preparing for it. And based on the most recent moves, I would suggest that it's coming sooner rather than later.
I've already bet a dinner with a friend of mine that the dollar is going to lose 30% during this decade. That was my assumption.
Well, I lived and worked in the United States for 17 years. I'm now in Toronto, Canada, and I moved every single dollar I have over into metals or Canadian dollars or a couple of other currencies, euros, as of last December. And I don't have any dollars on hand right now.
You moved back to civilization, David? Was it because of the baby? Because you were off the grid.
Yes. Well, there's 4 of them.
Wow. That's a change.
Yeah, there's 4 of them now.
Yeah. Okay. Is that why? Because I mean, you had the perfect setup for being able to not be in the middle of everything, and you moved back to a city.
Yeah. Well, I'm on the outskirts, but yes.
Yeah. Okay.
Still connected to civilization. Yes.
Okay. All right. Well, you're not Grizzly Adams anymore, so.
Well, actually, I have got my Grizzly Adams resort, if you want to put it that way. When everybody's dropping dead of coronavirus and the depression.
All right, so it's still your haven, and you can get away and get there. So,
yes.
But that's interesting that you're back in the city. So, anything else that you want to cover? I mean, I really appreciate you coming in here and talking about what's been, really. I was bearish last Saturday, and talking to my guys, I thought 3,100 was ambitious. So even overshot my expectations. And I thought that would take till March or April. So really, these markets are now in a position where it's like an auto wreck, and they're in shock. And it's going to take some time for, trading to get back to kind of a normal rhythm, or maybe that rhythm is gone for a while.
Yeah, I think volatility is here to stay now that this has started, and the extent of the move in such a short period of time should tell you the importance of the Fed to the market. By simply saying that they're stepping back a little bit, look what happened.
Wile E. Coyote.
Exactly. Thank you. Best reference.
Yeah.
Yes.
I mean, standing on the shelf a week ago on the rock, and it gave way this week. So
yeah.
Okay.
Yeah. There's a warning I want to send out to your listeners in the short term. For me, in these volatile markets, and as dangerous as this is right now, we could go straight back up. Nobody knows what's going to happen in the very short term. But I would say this: it's a good time to just step aside and break out a bag of popcorn and just watch it. For me, I'm waiting to see what the Fed does. Specifically, I'm waiting to see them step back in and say, either we're going to full-blown QE, or we have to ramp. There's another repo crisis, which forces us to go back to the repo market and spend even more. Just watch their balance sheet. And once the Fed does that, that's, for me, the signal that it's game on again. And they're going to start pumping this thing like no tomorrow. I do believe that if they can do this one more time, it will be the last time that they pump it. It will be a blow-off top. And after that is the Great Depression. Now, that's just me talking. That's my humble opinion. Take it for what it is.
Yeah.
But this market
they have one more trick left in the bag.
Yes, they can throw the kitchen sink at this, but they sacrifice the dollar in the process. Right. And that is ultimately what leads to hyperinflation, and that ultimately leads to a deflationary collapse, which is the Great Depression 2.0. And I don't see any other way out. But in the short term, step to the side, watch what happens. And when they come in, if you want to take a shot at it, buy stocks, buy everything but the dollar, as I said back in 2017. But for me, the safest harbor of all to be in, and I've been buying since 2015, is gold, silver, the physical metals. Use the miners as a trade, because there'll be spectacular gains on those when this bottoms.
But a very nicely leveraged trade in the miners. I mean, if gold explodes, they will explode times 5, times 10, some of them.
Yes, and I like silver even more so, Steve. I think silver is going to gold always well, not always, but typically outperforms initially. But once the rally is established, silver catches up and then just passes gold by,
and
waves
silver
at
is
it as it does.
silver is still. I mean, in
I'm
all the
showing the
ratios.
gold-silver ratio right here,
Yeah.
David. You see it?
No,
Oh,
you're
yeah,
sharing
you're
the
showing
screen.
the screen. All right.
Yes.
Anyway, we'll wrap it.
Yeah,
with,
so silver has so much room to move to the upside. I mean, it was at 50, right, before the.
There you go. New
recent
highs
crisis.
on the gold-silver ratio right there,
Yeah.
Yeah.
if you see it. So
And
would you put on this trade and start selling 1 ounce of gold to get 95 ounces of silver right here?
you could, or you could just wait for the Fed to show up and then do it. I mean, once the Fed comes in, that's the bottom for the metals as far as I'm concerned, and then silver will start to outpace gold. And actually, this chart, if you look back at this chart for 2008 and what happened to the gold-silver ratio, I had it on my presentation. Gold-silver ratio fell from
this.
Yeah, all the way down to 30. So it's actually in the 20s.
Wow.
And so you could get a 4x move in silver relative to gold. On top of any appreciation in gold, say gold doubles or triples, silver is going to go up 4 times. 8, 24 times. And that's typically what's happened in the past. If you look at the 70s and you look at the 2000s, silver went up 36 times in the 70s. Gold went up 24. And silver outperformed gold in the 2000s as well. I expect the same and even more so next time around. Silver is still underperforming gold right now. When the rally is truly established, when the next wave 3 of 3 kicks in, it's just goodbye. This goes to the stratosphere. And
David, I have one last question for you.
Yes.
There are a lot of people that are trying to convince investors that cryptocurrencies and especially Bitcoin is the new gold. Personally, I'm not buying it. I haven't even seen how they would perform through a single business cycle. So personally, I'm not buying that. I'm also in physical gold, and I'm going to remain there. But what do you think is going to happen to cryptocurrencies? Let's say Bitcoin, which is like the blue chip of cryptocurrencies, during such a period. Do you think since they're the most speculative instruments, can vanish, or do you think that they can actually benefit a lot?
If this was a free market, a capitalist world, which it most certainly is not, I would say cryptocurrencies, Bitcoin in particular, would do extraordinarily well. Unfortunately, I'm on Danielle DiMartino put out did an interview a little over a year ago on this, and I'm with her 100%. She said this basically: the monetary authorities around the world, the central banks and their backers, those who own, they're all private institutions, will not allow a competing monetary regime. You've got these central banks talking about central bank digital currencies right now. Lagarde's one of the biggest pioneers of it. And we just talked earlier on about a potential digital global reserve currency. Do you think those central banks, those monetary authorities, are going to allow private
give up their monopoly?
Yes, to compete? No. They're going to crush it. How do they crush it? They don't allow it to be used for any business whatsoever. They tell all the banks to reject it. They tell all the corporations to reject it. You can't use it on Amazon. They tell every retailer in the world that if you touch this, we're going to crush you. We're going to indict you. So I'm with Danielle DiMartino. If this was a free market, I would say yes, it absolutely could probably exceed gold in terms of gains. But because of the world we live in today, very Orwellian overreach in every aspect, I expect them to not allow any competition to their own digital currencies when the time comes. And so, no, I don't think that's a viable alternative.
Okay, thank you so much, David, for dropping by. And let's not let as much time pass for a return. And I wish you and your family the best. Being back in Toronto, it's my hometown is Chicago, so you're in Chicago, sister city. And, you know, I really hope I get to meet you someday, David, and break bread with you. And
that'd be great.
I really appreciate you coming in and capping off a very historic week with a calm and insightful narrative for people to digest over the weekend. Thank you for edifying faith today, David.
Dale, one last thing on that. I say it's up to you to bring me back. I'll come on
Okay.
anytime. You know me.
All right.
But I'd also add just one last comment. The takeaway is, I've said it multiple times during this interview. I mean, next time Steve can do the interview for me, because he and I seem to have exactly the same thought. But anyway, with regard to the Fed, just watch for when they go back in the opposite direction. Watch for the about turn. Watch for the 180. That'll be your signal. And you know, if you want confirmation, wait to see a bottom in stocks, and stocks start to go back up after whatever the Fed says or does. And when that happens, don't worry about missing the bottom, because if they are going to throw the kitchen sink at this thing, which I believe they will, stocks could double. If we go down to 2100 or triple, the gold and silver just see ya. It's like they're gone. You're talking silly numbers at that point. Just watch for the Fed 180, and that's the key.
Okay, buddy. Don't fight the Fed.
Don't fight the Fed. Just jump on the ride.
All right, buddy. Thank you so much, David. Have a great weekend.
Have a great weekend, David.
I appreciate you being here with us today.
Thank you for having me on, guys. Appreciate it.
Steve, thank you very much for conducting this interview. You could write the tagline.
Thank you, Dale.
Okay, because you were here, right? And everybody, thanks for hanging out with us this week. I hope no one got hurt. I hope maybe a few of you people listened to us, and, you know, we're long some VIX. I mean, I certainly didn't ride it to 39, but 28 wasn't a bad ride. And we'll see what happens next week. We're going to do our best to keep you guys safe and look for low risk, high probability setups. Don't forget to subscribe, and really you have a team that you can't find elsewhere, all in one location. So don't just count your pips, count your blessings, and we'll see everyone on Monday. Adios. Have a great weekend, Steve.
You too, Coach. You and everybody else.
Okay. Can you oh, there, I could end the meeting. Okay, so that's it, everyone. Enjoy, and watch all the Sunday talk shows, and keep Valium nearby. And I'll talk to you later on. Adios.